Hello, this is Japanese Economic Review Channel. Welcome to this deep dive broadcast. Imagine watching 3,000 points just evaporate from a major index in a single day.
Yeah, that is the kind of historic sudden drop that makes floor traders physically nauseous, honestly.
Right. It is the kind of headline that makes you want to, pull all your capital out and hide it under a mattress. But what if I told you that beneath that apocalyptic headline, 60% of the market was quietly doing just fine?
I mean, it's a massive disconnect between the headline and the reality, and it is exactly why you have to look under the hood of these indices.
And that is exactly what we are doing today. If you're watching us right now, you can see the visual backdrop behind us. It reflects a dynamic, high-tech financial newsroom.
Right, yeah, we are not just sharing some personal notes or passing thoughts today.
Exactly. We are analyzing freshly published hard market statistics to figure out what is really going on.
We're looking directly at the data driving the capital flows, like right this second.
Specifically, we're diving into a highly anticipated report. It's the Weekly Domestic Outlook for the week of June 29 to July 3, 2026.
A very big week.
Huge. And our mission today is straightforward. We're going to cut through the absolute noise of the recent market volatility.
Yeah.
We want to decipher what this published data is actually telling us about where the smart institutional money is moving. And we want to prep you for what is shaping up to be a completely pivotal week in both Japanese and global finance.
And, noise is the absolute best word for it. It has been a historically chaotic few days for anyone watching the tickers.
Okay, let's unpack this because we have to start with the biggest indicator of market health out there. The wild roller coaster fluctuations of the Nikkei average.
The raw numbers are just staggering.
They really are. I mean, we watched the Nikkei surge, drop below the massive 70,000 milestone, hit a record high, and then absolutely plummet. We're talking about a daily drop of 3,005.46 points. Yeah, it closed down at 69,360.888. And it wasn't just the Nikkei, right? The Topix also took a major hit, falling to 363.36.
A 3,000-point swing in a single session. Like, when you see a number like that, it feels like the floor is completely giving out on the entire Japanese economy.
But the report identifies a very specific culprit for this avalanche. It points directly to AI stock adjustments.
Right.
It seems like short-term funds that were, pouring into Japanese equities with reckless abandon are aggressively reversing course now that the psychological 70,000-point target was hit.
Well, the underlying anxiety in the market seems to be that while the semiconductor companies, the ones selling the AI pickaxes, so to speak, are seeing huge profits, the market is suddenly waking up.
Waking up to what, exactly?
Waking up to a very specific structural reality about how these technologies are actually funded.
Oh, right. The reality that these massive astronomical investments by the hyperscalers,
The giant U.S. tech companies.
yeah, the ones building the AI infrastructure, the server farms, the data centers, that they might eventually hit a capital expenditure limit.
Exactly.
So if everyone was selling shovels for the AI gold rush, are we just seeing the miners take a quick coffee break, or is the gold actually running out?
That is the big question.
But wait, I need to push back on the math here for a second. You mentioned earlier that a huge chunk of the market was doing fine during this bloodbath.
Yeah, it was.
How can an index drop 3,000 points if the majority of the companies in it aren't collapsing? Like, that feels completely broken.
It sounds broken, I know, but it is actually just a quirk of how these indices are constructed.
Okay.
What's fascinating here is the stark contrast between those alarming headline numbers and the actual underlying resilience of the broader market. The report highlights a massive silver lining. Despite the 3,000-point drop in the Nikkei, less than 40% of the stocks on the prime market actually fell.
I am still trying to wrap my head around that. Just so we are clear, for you listening at home, the prime market is the top tier of the Tokyo Stock Exchange.
Yeah. Correct, yes.
It has the strictest criteria for market capitalization and corporate governance. So you are saying that in Japan's most elite tier of companies, more than 60% either held their ground or went up on a day. The main index crashed 3,000 points.
Precisely. And the reason for this disconnect, it comes down to weighting.
Weighting.
Yeah, the Nikkei 225 is what we call a price-weighted index. That means companies with a very high individual share price have a disproportionate massive impact on the index's overall movement.
Oh, I see.
In Japan right now, a handful of massive tech and semiconductor companies, the ones directly tied to those AI hyperscalers, they have incredibly high share prices.
Yeah.
So they dominate the Nikkei.
So when the AI sector sneezes, The Nikkei catches the flu.
Exactly. The AI stocks adjusted violently downward because investors got nervous about the hyperscalers' budgets. That single adjustment dragged the entire Nikkei down 3,000 points.
But the TOPIX.
Right. The TOPIX, which you mentioned earlier, is a much broader market capitalization weighted index. It includes all the companies on the prime market.
Yep.
And when you look at that broader picture, the rest of the companies, the ones not selling AI shovels, didn't panic at all.
Wow.
The miners might be taking a coffee break and the shovel sellers might be panicking, but the rest of the town is very much still open for business.
That is such an important distinction because it completely shifts the narrative from a market-wide collapse to just, a highly concentrated sector adjustment.
Absolutely.
So if the broader market didn't panic when the money rapidly left the AI sector, where is all that capital actually flowing?
That is the trillion-yen question.
And more importantly, what is stopping the broader market from just surging upward right now?
Right, and that is where we have to look at the immediate technical mechanics of the market, because there is a massive headwind approaching this week.
A headwind that retail investors miss.
Yeah, a lot of retail investors get blindsided by this because they only look at whether a company is fundamentally good or bad. They ignore the plumbing of the market, so to speak.
Well, the report gives a very clear, bold text warning about upcoming dividend payment concentrations and some massive ETF settlement days.
Yes, July 8th and July 10th.
Okay.
If you are tracking Japanese equities, you need to circle those dates in red ink. The data in the weekly domestic outlook shows that selling pressure just to fund these ETF distributions could hit an unbelievable 1.7 trillion yen.
Wait, 1.7 trillion yen. That is a staggering amount of selling pressure. Let's explain the mechanics of why this happens, because it's fascinating.
Let's do it.
For the listener, an ETF, or exchange-traded fund, is a basket of stocks that tracks an index. But people forget that ETFs don't just sit on giant piles of cash.
No, they don't.
They are fully invested in the market to ensure they track the index perfectly, right?
They are completely maxed out on equities, yes.
So when these massive ETFs hit their specific settlement days and are legally required to pay out dividends to their investors, they literally do not have the cash on hand.
Right.
They are forced to sell their underlying stocks into the open market to generate that 1.7 trillion yen in physical cash just to make the dividend payments.
It is forced selling. It has absolutely zero to do with corporate earnings or AI or the overall health of the Japanese economy.
Just mechanics.
It is purely mechanical plumbing. And this is where it gets highly predatory, honestly. Hedge funds and institutional traders know exactly when these settlement dates are.
Because it's public knowledge.
Exactly. They know this 1.7 trillion yen forced selling is coming.
So they front run it.
Exactly. Hedge funds will short the market ahead of time. They borrow shares and sell them, betting the price will drop because they know the ETFs are going to be forced to flood the market with sell orders anyway.
That is wild.
This creates a massive, heavy lid on how high the Japanese market can go in the short term. It's why the report explicitly forecasts the Nikkei to stay trapped within a range of 66,500 and 70,500 this week.
So the ceiling is just too heavy to break through until those ETFs finish their selling. That makes perfect sense. But within that constrained range, there is still money moving around. The report highlights a very clear shift. Capital is rotating aggressively away from the depleted AI tech sector and moving into sectors tied to the government's upcoming basic policy on economic and fiscal management and reform,
Right.
which is known domestically as the Honobudo no Hoshin.
The Grand Policy Framework. This is the official blueprint for where the Japanese government is going to direct its vast resources over the next fiscal year.
And the specific rotation targets listed in the data are incredibly distinct. We're looking at defense, robotics, energy, space, entertainment, and disaster prevention.
It's a very specific list.
It really reminds me of crop rotation in traditional farming. If the AI soil is completely depleted of nutrients and needs a season to recover, investors are essentially walking over to the next field and planting their seeds in defense and robotics.
The crop rotation analogy works perfectly, but we need to look at why they are choosing those specific fields.
Right, because my main question is this. With that 1.7 trillion yen in ETF selling pressure looming right over our heads, how much of this sector rotation is a genuine long-term belief in these specific industries? And how much is just investors finding a temporary, safe place to hide from the AI storm?
It's a phenomenal question. To answer it, we have to contrast structural growth with cyclical growth.
Okay, break that down.
Well, when a sector like AI, which relies entirely on the cyclical whims of private U.S. tech giants deciding to spend billions, when that starts to look shaky, Institutional investors crave absolute certainty.
And the government provides that.
Exactly. Government policy, like the Hanabudo no Hoshin, provides a guaranteed structural roadmap of where public money is going to flow, regardless of what the stock market is actually doing.
So it's locked in capital.
Yes. Look at the specific sectors you mentioned. Disaster prevention isn't a fad in Japan. Given the geographic reality of earthquakes and extreme weather, it is a perpetual state-funded necessity. Robotics isn't just cool technology. Given Japan's rapidly aging demographic and labor shortage, it is vital to national survival. Defense spending is being structurally mandated to increase due to geopolitical tensions. This isn't cyclical, this is structural.
So it's not just a place to hide. It's a place to hide that comes with a guaranteed government-backed yield.
Precisely. Investors are taking their massive profits from the AI gold rush and parking them in sectors where the Japanese government has explicitly promised to spend billions of yen. It is a very calculated defensive maneuver.
I see what you're saying.
Yeah.
But if you were an international investor planting those defensive seeds in the Japanese market, you are buying those assets using the Japanese yen.
You are.
You cannot understand the flow of capital in Japan without looking at the currency it is all denominated in. This massive shift in equity markets is happening against the backdrop of a historically punishingly weak yen.
The currency dynamic is arguably the most important subplot in this entire report. It dictates everything else.
And the numbers are staggering. The report details the U.S. dollar to Japanese yen movement. It has been hovering near 161.66, and earlier in the week, it actually touched a roughly two-year high of 161.93.
Yeah.
The primary driver, according to the data, is the expanding interest rate gap between the United States and Japan. Can we pause here and actually explain the mechanics of this? Why does an interest rate gap crush a currency so violently?
It is all based on a mechanism called the carry trade. Think of global capital as water.
Okay, water.
Water will always flow down the path of least resistance to the lowest point. In finance, capital flows to wherever it can get the highest yield with the least amount of risk. Right now, the Bank of Japan has interest rates near zero. The U.S. Federal Reserve has interest rates significantly higher, around 5%.
So it is a massive disparity.
A massive risk-free disparity. So if you are a huge global fund, you can essentially borrow money in Japanese yen for almost nothing, 0% interest. Take those yen, convert them into U.S. dollars, and buy a safe U.S. Treasury bond yielding 5%. You are basically printing free money, pocketing the difference. But to do that, you have to continually sell yen and buy dollars.
And that relentless selling pressure on the yen drives its value into the ground.
Exactly. As long as that gap exists, gravity will pull the yen down.
Which brings us to the political drama. Here's where it gets really interesting.
It's the talks.
The report mentions a specific catalyst that caused the yen to briefly dip back down to 161. Online talks between Japanese Finance Minister Katayama and U.S. Treasury Secretary Bessent.
Right.
Now, to be clear to you listening, we're not taking any sides on the policies or the politics of these officials. We are strictly looking at how the foreign exchange market reacted to their meeting.
Right, keeping it strictly to the market impact.
Exactly. The market instantly priced in the possibility of government intervention just because they had a conversation. The report gives us clear boundaries. The market is hyper-vigilant, using the 25-day moving average to set a floor at 160.000 and a ceiling at 162.50. It feels like the market is playing a game of chicken with the Bank of Japan, daring them to intervene.
I would actually frame it differently. If we connect this to the bigger picture, it is less like a game of chicken and more like a dam holding back a massive reservoir of water.
Back to the water analogy.
Yes. The market is constantly pushing the water against the Bank of Japan's dam. When the market heard about the Katayama-Bessent talks, it was just a rumor that the BOJ might pour more concrete to reinforce the dam.
But a rumor doesn't actually hold back water.
Precisely. Political meetings between finance ministers create short-term ripples, like that brief dip to 161, but those are emotional, fleeting reactions from the market.
Because the fundamentals haven't changed.
Right. Rumors don't change the structural reality. The only thing that actually lowers the water pressure against the dam is a change in the interest rate gap. And right now, the steering wheel for that gap is being held in Washington, not Tokyo.
So if the BOJ's hands are essentially tied by U.S. monetary policy, that means Tokyo is essentially holding its breath for Washington's next economic data release. When exactly does the hammer fall on that?
Well, this is where we transition from macroeconomic theory to the practical calendar for the week ahead. The report gives us a very specific roadmap of upcoming published statistics that will trigger the next major moves.
Let's walk through this timeline because it is packed, and we need to understand the butterfly effect of these data points.
Sure.
On June 30th, we have the Japanese jobless rate and industrial production numbers coming out, alongside U.S. consumer confidence.
Those are important baseline indicators for sure, but they are really just the appetizer for the week.
Right, because July 1st brings a major domestic release, the BOJ Tankin Survey.
Yes.
For those unfamiliar, the Tankin is a massive, comprehensive survey conducted by the Bank of Japan. They literally ask thousands of corporate executives across the country about their business conditions and expectations. It's essentially a giant temperature check of Japanese corporate
It
sentiment.
was a very crucial one, too.
And on that same day, we also get the U.S. ADP employment numbers and the ISM Manufacturing Index.
The Tenkin is critical for understanding domestic momentum, especially for those Hanbudo no Hushin sectors we discussed. But all of that data is still overshadowed by what happens the following day.
July 2nd. The ultimate spotlight. The U.S. employment statistics, specifically the non-farm payrolls. The report notes a very specific, highly anticipated market expectation here.
Yes, it does. The forecast is that U.S. non-farm payrolls are expected to drop significantly, showing an increase of only 130,000 jobs.
Only 130,000.
Right, which is a massive step down from the 172,000 job increase we saw in May.
And finally, July 3rd is a U.S. market holiday, which usually means global liquidity just dries up completely. Trading volume plummets, which can sometimes lead to erratic price swings if a sudden piece of news breaks.
It can get very choppy, yeah.
So looking at this gauntlet of data, so what does this all mean? If the listener sitting at home is trying to navigate this volatility and only pays attention to one single data point this week to understand where the yen and the Japanese market are going, which one is it?
It is unequivocally that July 2nd U.S. jobs report. Yes. That specific number, the expectation of a drop to 130,000, is the linchpin for every single dynamic we have discussed today.
Let's trace that butterfly effect. How does a restaurant worker getting hired or not getting hired in Ohio dictate the stock price of a robotics firm in Tokyo?
Think about the mechanics of the dam we just talked about.
Right.
If the U.S. labor market is visibly cooling down, which a drop to 130,000 new jobs would clearly indicate, it means the broader U.S. economy is slowing.
Okay.
If the economy is slowing, inflation pressures ease. And if inflation eases, the Federal Reserve has a much stronger, data-driven justification to finally start cutting U.S. interest rates.
And if U.S. interest rates go down,
Yeah.
the gap closes.
The gap between U.S. and Japanese rates narrows, the carry trade becomes slightly less profitable, the U.S. dollar becomes slightly less attractive, and capital flows back into the yen. The yen strengthens naturally. A significantly weak U.S. jobs report could actually rescue the yen from this dangerous 161 level without the Japanese government having to spend a single dime of its foreign reserves on a risky market intervention. It would solve the Bank of Japan's problem organically.
That is a phenomenal insight. A weak jobs report in America acts as a natural pressure release valve for the entire Japanese currency market.
Exactly.
And if that happens, if the yen strengthens, the whole macroeconomic backdrop shifts.
Yeah.
The dynamic for Japanese exporters changes because their goods become slightly more expensive abroad.
Yeah.
The cost of importing energy into Japan drops, which helps domestic manufacturers, and that crop rotation we talked about into government-backed sectors like defense and disaster prevention, it gets a whole new context if the currency stabilizes.
It is all deeply fundamentally interconnected. You simply cannot look at the Nikkei's 3,000-point drop in a vacuum.
Yeah.
You have to look at the forced ETF dividend settlements on July 8th, the structural spending of the Hanabudo no Hoshin policy, the mechanics of the U.S.-Japan carry trade, and ultimately, how many people got hired in the United States last month.
It really is a massive, complex breathing machine. Which brings me to one final thought, something I want to leave you, the listener, to ponder as you watch the markets open this week and digest all this data.
What's that?
We talked extensively about how the broader market is hiding from the AI volatility by moving into structural government-backed sectors like defense, space exploration, and robotics.
Right.
But think about this scenario. If those hyperscalers, the massive U.S. tech giants, if they do hit a hard capital expenditure limit on their AI infrastructure investments much sooner than expected, how will that rapid, sudden deceleration ripple through those secondary, non-tech Japanese sectors that are currently acting as our safe havens?
Oh, wow. That is the multi-trillion yen question.
Because when you really think about it, modern defense systems, modern space exploration, and advanced industrial robotics, they all run on the very AI infrastructure that the market is currently adjusting away from.
They absolutely do.
If the foundation of AI development slows down, do the advancements in robotics slow down with it? Are the safe havens actually as insulated as they seem, or are they just the next domino in the chain?
It's a sobering thought.
It's definitely something to
Sounds
keep
like
in
it.
mind as we navigate this wild diagnostic landscape of the current market.
Absolutely.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.